Investing in real estate is a big deal because it's probably the most expensive single asset that you'll be investing in. And if you're just starting out, it could most likely take up all of your savings. You hear that you shouldn't put all your eggs in one basket. So if your main investing goal is to maintain a safe, diversified portfolio while maximizing returns, is there a best time to get started in real estate? In this video, let's figure out what's better, and I'll illustrate this by comparing two strategies. One, diving right into buying a property once you've accumulated enough capital, then diversifying into stocks later once you make enough money. Versus two, investing in stocks first and then investing in real estate later, so you're not putting all of your money in a single property first. If this is your first time tuning in, we post weekly real estate investing videos specifically for Toronto investors, so don't forget to subscribe to our Elevate channel so you don't miss other videos from us. I know, the stock market has been making massive gains recently, but honestly, this is actually not very normal and really risky. The big swings are caused by a lot of speculation and noise, and a lot of times it's completely detached from fundamentals. So when I refer to stocks in this video, I'm not talking about the higher risk positions that have big swings. Instead, we'll focus on investing in index stocks where you can buy and hold and you're not trading on margin, and you don't need to worry too much about short-term fluctuations because in the long run, business returns as a basket does go up. According to Investopedia, the long-term average annual return for the S&P 500 index from 1957 to 2018 is around 8%. And now on the real estate side, I'll also assume that you're in it for the long haul. So your returns come from appreciation and rental income, and it's magnified through leverage. This means if you're looking at a typical Toronto condo, we're looking at total returns of 15 to 20% based on a 20% down payment and 5% annual appreciation. Now, real estate without leverage is lower risk than stocks. If you factor in leverage, then their risk levels become more comparable. If you want to learn more about this comparison, you can check out this video right here. Now, comparing just the two investments, I'd have to say that real estate is the better performer based on risk and reward. It has higher long-term returns with similar risk. But of course, unpredictable things can happen, and real estate doesn't often move in line with stocks. So if you're a responsible investor, you'd want to diversify your portfolio so that you can lower your total investment risk, especially when your total pot of wealth gets bigger and bigger. So our goal in this video really is to figure out how we can maximize the time that our portfolio is diversified while still optimizing for the highest possible returns. I can dive into a detailed financial analysis, but the answer is pretty obvious once I walk you through it, so we'll just do a simple back of the napkin calculation to keep things simple. So let's assume that you have $115,000 to invest. The first alternative is to put all of it into a Toronto condo that costs $500,000. At the end of 3 years, you gain $78,000 in appreciation at 5% growth per year, and because of that, you can go back to the bank and refinance to take out 80% of it, and you're left with $60,000 to invest in stocks starting year 4. Based on a 10-year investment time frame, this is how your portfolio would look like. You'd have a big amount of real estate in your portfolio for a full 10 years and only 3 years where your portfolio is not diversified. Let's look at alternative 2, where you invest in stocks first, and once you save enough to keep $60,000 in stocks, you would take the rest of your money and buy real estate at that later time. When you're investing in the S&P 500 index, it takes you around 6 years to make $60,000. Which takes your total portfolio size to $175,000. Then, when you sell the stocks, you'd have to pay capital gains tax. This would take you down to $100,000 of net capital to invest in real estate, assuming you're taxed at the highest tax bracket. With this budget, you probably won't be able to buy a condo 6 years later, especially since property prices would be much higher then, so you'd have to buy an older apartment if you don't want to pay extra money, or top it up with extra savings, or continue to wait a little bit longer before you buy into a condo. So from this basic comparison of the two scenarios, here's a few things to note. 1. If you're looking at total time diversified, you're better off with buying real estate first since you only have 3 years holding one type of assets, whereas buying stocks first means you'll have at least 6 years with only stocks. 2, when you buy stocks first, your portfolio's total returns would be lower because you have less time and less money in real estate. And 3, when you buy stocks and then you buy real estate, you'd have to sell your investments, so your money is reduced from capital gains tax. This reduces the amount you can reinvest compared to refinancing using real estate. So we have a clear winner here. Alternative 1, investing in real estate earlier can help you diversify better and at the same time generate better total returns. Now, even though it can seem like a big decision to put all your money in real estate, most real estate investors actually start this way simply because real estate costs a lot of money. If investing in real estate is part of your investing goals, consider starting as soon as possible in your investment journey. Real estate has higher returns, so you can grow your money quickly but safely compared to other riskier investment options that have similar rates of return. On top of this, when you're refinancing to reinvest, you're putting your money to highest and best use because you're deferring capital gains tax. All of this helps you get to the point where you can start diversifying sooner and you can achieve a higher performing, lower risk portfolio if you start investing in real estate sooner. When you work with our Elevate team, we'll get to know your situation, your budget, your mortgage qualifications, your preferences, your risk tolerance, and your investment goals so that we can guide you to make the best real estate investment decisions for you. Just head down to the link in the description below to connect with us. And finally, if you like this video, remember to give us a thumbs up and share it with your friends who might find this video useful. We post daily on social media, so look for us on Facebook, Instagram, or LinkedIn by searching at Elevate Realty CA. I wish you all the best in your real estate investing journey. Thanks so much for watching, and I'll see you in the next video. Bye.